Looks like we're going live. So, hi everybody. Welcome to Friday. It's good to be live. Good to be back. Doing the Friday thing live. Missed it. Um, so yeah. I'm Brett. Welcome to Friday Financial Fundamentals on Real World Recovery. Glad to be back. Doing it live. Yeah. Um, Hope everybody's had a good couple of weeks here. It was interesting doing them, recording them. It was a fun experience, but I'm glad to be back doing it live. I prefer doing these live and letting folks get connected in here. So yeah, wanted to get back to doing this. I'm excited I'm able to do this one live. We're doing a two-part series here. This is where we really get into the exciting stuff, I think. So if you've been following along here, we've done a lot of work to kind of build a foundation and get things sorted and in place to kind of get to this point. And so this is where we really start making our money work for us. And so I'm excited to get into this. If you haven't yet, please hit subscribe. That's how you can get into the chat, ask questions. If you've got questions, please, I'd love to hear from you as we go through this. And if you aren't watching live, if you watch this later and have questions, hop over to the Discord. Links are in the info for the video. Join into the Discord, or send me an email, or hop over to the Facebook or Instagram and message me there. I'd be happy to connect with you and we can talk more about this stuff, because this is really where we start getting our money to work for us, rather than working for our money. And that's really the key to this whole thing, is once we start making money in our sleep and having our money work passively for us, that's really where financial freedom starts to become a real possibility. And that's what this whole thing's about. So we'll jump right in. Today we're gonna tackle something that I think at least for me, was an intimidating thing to think about early on in recovery. But it's absolutely crucial for long-term stability, and it's investing. So don't worry, it's not like we're going to jump right into like Wolf of Wall Street or anything like that, and get into jargon and vocabulary and overwhelming details or anything. We're just going to break it down, like we have with all of the previous stuff, in very approachable way, very actionable, and try to tailor this in a way that's something that anybody in recovery who wants to, make money work for them, they can take this stuff and apply this to their situation. And I hope that there's some tips here that everybody can take advantage of. I know these things have worked for me, and like anything in recovery, there's a lot of tools and a lot of things out there. So take the things that make sense and take the things that work, and apply them. And if it doesn't make sense for you, or it doesn't seem like a good fit, then so be it. But we're going to break this out into two parts. The last time we touched on tax advantaged accounts, so I'm going to continue in this episode and go a little deeper into the tax advantaged accounts and kind of stay on that theme, because honestly, these are like some of the absolute best tools to start with. when building wealth. And in my opinion, they are the first priority as far as what should get your focus, because of the additional benefits, not only from an investing standpoint, but because there's the additional tax benefits. So it's like double, and sometimes, as we'll talk about later, triple benefit, to some of these vehicles, that you can take advantage of. And so you get just a huge maximum benefit out of your dollars. So we're going to talk about 401ks. We're going to talk about IRAs. We're going to talk about health savings accounts, or HSAs, as they're commonly called. And the reason that health savings accounts are in there is because they count as investment accounts. So get your notebooks or tablets or whatever you take your notes on. You're gonna wanna have this information handy. Settle in, and we're gonna jump right in. So first, tax advantage accounts. Basically, the like I was saying, the reason that they're such important tools to have in your kind of playbook is the multiple benefits. So, being investments, there's the possibility that they grow in value and earn you money, in that the whatever you're investing in appreciates in value. Also, they pay dividends sometimes. Sometimes companies have dividends that they pay their shareholders. It's kind of like works like interest. And then also, these types of accounts have tax advantages. So 401ks, IRAs, there's both traditional and Roth IRAs, and then health savings accounts. And so, the first thing we're going to look at, is, how they're designed to help both short-term and long-term, and kind of break that down. So first thing, 401k. Most folks through their employers are probably familiar with this. That most employers have this available. It's a pretty common thing these days. Benefits across the board. Helps employers attract employees and retain employees, because it's expensive to hire. On average, it costs anywhere from $10 to $30 or more $1,000 to hire an employee, between recruiting and onboarding and training and all of those things. It's expensive to hire folks. So when you do get somebody hired, you want to keep them for long enough that you can at least recoup the cost of hiring that person. So having reasons for them to stay is in the employer's best interest as well. It benefits the employee as well. So having a nest egg and having money available for their future when they're not able to work obviously makes sense to have some retirement available. And also it benefits society if they've got additional money available when they're older. Then it's less of a burden on society and the infrastructure required and taxpayers and stuff down the road. So 401ks are good for everybody. Pre-tax contributions. This is why it's a benefit on your tax bill. You get to put money into your 401k before you pay any taxes out of your paycheck. So it lowers your tax burden. And like we said in the last episode, taxes are basically incremental. So the first chunk of taxes come out at the lowest tax bracket. And then once you hit that level of income, then the next amount of wages that you make for that tax year come out at the next highest tax bracket, and then the next highest, and then the next highest. So if you're able to put money into these tax advantaged accounts, it reduces your tax burden, and so it effectively delays how long before you go into that next higher tax bracket, potentially preventing you from going into that next highest tax bracket altogether. So reducing your taxable income. That's the right now short-term benefit of it. So in this example that I've got, let's say you make $40,000 a year, but you contributed overall $4,000 to your 401k. Your total taxable income then drops to $36,000 for the year. So you have effectively lowered your taxable income by $4,000. So just for simple math, if your overall tax rate is, your average tax rate comes out to 20%, then instead of paying whatever that is, what, $8,000, it would be 7,200. So you save about $800 then in that example. So it's pretty good savings then, just for saving your own money. So not only did you save $4,000 for retirement, you also saved $800 on taxes. So pretty good deal. Now the other advantage to a 401k is employer matching. So as we talked about in the last episode, this is free money. And this is the biggest advantage for me, in my opinion. So like at my previous job, I had, and this is the recommendation I give everybody, is max this out. I whatever it takes. If they're willing to give me free money, I'm going to get every penny of it, because the way it worked was basically if I maxed out my employer match, I was getting 50 cents on the dollar. So no matter what happened in the stock market or whatever, for every dollar I was putting in, I was getting 50 cents put in from my employer as well. So if I put in $100 into my retirement, there was actually $150 going in. So I'm at plus 50% before anything happens in investment world. There's not even Warren Buffett can get 50% of returns in the stock market. Like, it just doesn't happen. Nobody can beat that. So, and if the stock market goes up, then I'm at 50% plus whatever it went up. If it goes down, I started 50% up and then went down a bit. So, there really wasn't much way to lose. So I tell everybody, take advantage of that no matter what, even if it means like figuring out like how I, whatever else I got to do to, figure out my budget some other way to either make a little bit of extra money somewhere, or tighten up somewhere else, or maybe find another job, whatever it is. But like, I'm maxing that out. If I'm going to get that much free money, I'm taking advantage of it. Like, there's nothing out there. There's no cell phone cool enough. There's no whatever that I'm not going to take advantage of that kind of extra money. And a little later I'll show you again with some of the tools that we're going to use in one of the later sections here, just how much money that ends up being if I don't take advantage of it, how much I'm leaving on the table when it comes time to actually look at cashing that in at retirement. So the other third big advantage of this is tax deferred growth. So tax deferred growth means since I'm putting it in from my check pre-tax, I don't actually have to pay taxes on it. Not yet. Tax deferred growth means that it sits in that account and grows and grows and grows, and all of the gains from stock market growth and dividends and anything that happens in the stock market and in that account all happen tax deferred until I retire or decide to pull it out of there. Once I cash that out of the account, that's what's known as a taxable event. And at that time, then I would pay income tax on it. So that could potentially be, 20, 30 years or longer, depending on how old I am. So if you've got kids and you start a retirement account for them when they're very young, it could be 50, 60 years. And so like that much time before it actually comes due and they actually have to pay income taxes on it, it's a drop in the bucket compared to how much growth happened. And so the other thought behind it is when we look back at how income taxes are calculated, since it's considered marginal tax rate, the thought behind this is if you don't think that you're going to be making as much money when you're older as you are when you're younger, having a tax deferred account makes more sense. So if you're thinking when you retire that you're going to be able to stagger how much you're withdrawing from your retirement accounts, so like you're just taking like minimum distributions or smaller amounts out of your account every year, because say maybe you've got a house that's paid for, so you don't need to take out huge amounts of money to pay for a house, or you maybe go on a vacation once a year or whatever. You're not pulling as much money out because your kids are grown up, and you don't have to buy all of these fancy things and pay to go out to eat, and you don't need to buy suits, and you don't have the kind of expenses and lifestyle that you have when you're younger and working and all of the hustle and bustle. So you're living a more modest, less expensive life, let's say. So you're pulling less money out of your account, and so you stay in a lower tax bracket, so you're paying less income taxes at that age. So you're able to pay even less taxes on that tax deferred account in retirement. And so you're actually getting a better deal on that money in later in life than you would now anyway, because of how that works out. So extra advantages there. So even if early in recovery, like when I first started working early in recovery, I was getting myself out of debt. So don't think like my very first paycheck from my very first job when I first got clean, I was maxing this out. No, that I'd be feeding you a line of hooey. But when I got to a point where I was out of debt and when I did all of the things from these earlier episodes and I got myself to a point where I could do this, then I built up to a point where I could max this stuff out. But even from an early point, like I was still like had this in mind that this was where I wanted to get to. So like that's what I want to drive home here is like the importance of why we do all of these things is to get to a point where we can start having our money start working for us in this way. So like, we start baby steps and start making progress and start chipping away at the bigger problems. And, we can start making 1% of our check, and then maybe 2% of our check, and then maybe 3% of our check, and just a little bit at a time. And as we make those incremental changes, that's how it sticks, right? Like we talked about that in previous episodes as well, where those small incremental changes is how we make those lasting changes and make them stick. So like I don't want to give the wrong impression that like we need to go jump all the way into the deep end feet first and dive in and do this all at once. So I want to be very careful not to give that kind of message here, but I do want to stress the importance of the value of these accounts and what these things can do for us. So that said, now we move on to one of my favorites, the Roth IRA. This is the traditional IRA, which the traditional IRA is very similar to a 401k in that it's tax deferred. This is the IRA stands for individual retirement account. So it's a similar type of a vehicle to a 401k. It's not through an employer. It's just something that an individual can set up. So, their accounts, like I said, you can set up yourself. You through like a Fidelity or Vanguard or Schwab or any of these investment accounts that we've talked about, where I've had to look at for setting up brokerage accounts and things like that. They all have those options. Most of your credit unions, banks will have them too. But the traditional, like I said, pre-tax, so tax deferred growth, and these are great if like you're in a higher tax bracket now and you think that when you're older you'll probably be making or pulling less money than you do now. My favorite is the Roth IRA. So these I feel are a good counterbalance to a 401k, because the 401k is your tax deferred growth, right? And then I like also having something that grows tax free. So I've got kind of the counterbalance, because then my tax deferred, that's the thing I'll pay income taxes on down the road. And then if I've also got something that when I pull the money out down the road, I can pull out tax free. So like if I've got a separate account besides my tax deferred account, but this thing is like, who knows what I want to do later in life. Maybe I want to splurge and, make some big purchase. And I do want to pull some big amount of money out. I don't want to accidentally put myself into a high income tax bracket. So having a account that grows tax free allows that to be an option as well. So having both is just planning for that possibility and giving myself that option. So a Roth IRA does exactly that. So this is where I put my money in after taxes. So after taxes come out of my paycheck, this is where I put money in after tax. So this account is interesting. So I put money in there after tax. Everything that happens in that account then grows tax free. And then if I take money out of there after retirement, tax free. So there are limits with this to how much can be put in there. And there are also income limits to how much you can make to be able to put money into one of these accounts. I believe it's somewhere in the ballpark of like $130,000 a year. If you make more than that, there are options for what's called like a backdoor Roth IRA to be able to do it. But that's stuff for, if you're in those kind of situations, talk to a financial professional, or at least do some Google searching on your own. That's not what my channel's for. I am not a financial professional. I'm just here to kind of give you some basics and say these things exist, and kind of show you some of the stuff that's helped me in my journey here. So what I love about a Roth IRA is, besides the stuff I told you about, is it also acts as a really nice like peace of mind account for somebody in recovery. Like when I was early on, one of the first things that made me a little leery about retirement accounts was, well, that's so far away. Like what happens if I have an emergency and I like need money now, right? What happens if what about this? What about that? I'm very good at creating catastrophes in my mind. And so the nice thing with a Roth IRA is anything that I put in there, any of the dollars that I put in, I am allowed to take those dollars out without penalty. The only thing that I would get a penalty for taking out early would be any of the growth or dividends or interest or any of those things. So it does give that peace of mind, as a kind of an emergency fund. Obviously, anything that I pull out of there isn't going to grow, so it's not a good idea to do that. It's not. So there's other in our previous lessons, excuse me, in our previous lessons, I've got other strategies that I've told you about as far as our short and even midterm savings accounts and things like that for emergencies and rainy day funds and things like that. But it really helped put me at ease to know that, like, if everything was burning down around me and I absolutely had to, it was an option. And so it was a little easier to be like, okay, I don't mind this idea of let me get started. So I told you about in my little teaser I floated out there about an idea of $19 a day, right? And you probably know that when I said a tax-free $1 million account, now that I've told you about a Roth IRA being a tax-free growth and account that you can withdraw from, well, guess what? We're gonna show you here. So Roth IRA, you can put a maximum currently in 2024, and I believe 2025 it's not changing. So the current maximum you can put in a year is $7,000. So we take $7,000, we're going to divide that by 365. That's $19. Well, $19.18. So find 18 pennies throughout the day too, but $19. Okay. So we're going to take that $19. So $7,000. Let's divide it by 12 months. $583.33. Okay. Now we can put the calculator away. But now what we're going to do, we're going to go back to my my handy website here on investor.gov. Remember this? Compound interest calculator. Yeah, you know how I love that. So let's say somebody's 35 years old. That's fairly average age. That means they got 30 years of before retirement, right? That's 30 years of working. And we're going to just have, we're not going to talk about 401k. We're not going to talk about any other investing accounts at all. All we're going to have them do is a Roth IRA. That's it. And they're just going to max out their Roth IRA. That's the only thing they're going to do. So they're going to put in their monthly contribution. They're going to put in their they're going to catch up. Okay. So they're going to max out this year. They're going to take their tax return or whatever they can. We're going to max that out. Start off with $7,000. And then starting next year, every month, we're going to just put in the $583.33 for 30 years till retirement. And I went over, this is Google's our friend, S&P 500. That doesn't have to be anything fancy. The S&P 500 is the benchmark that all of the stock market and everything uses to see how stocks are doing. The S&P 500 index fund is like the benchmark. It's averaged 10% returns. And so we plugged in 10%. We're only going to compound it annually, when in reality, if you put it into a S&P 500 index fund, you would actually take it and you'd put in usually quarterly, and so you'd do like 2.5% quarterly. But we're just going to do 10% annually. We're going to calculate that out. 1.272 whatever million. So that's it. That's all you got to do. That comes out to $19 a day. That's it. One account, one index fund, average returns, nothing fancy. Just a little over $1.25 million in that one account. Tax free. And that's just sitting there then when that person retires. So, and that's not counting a 401k. That's not counting any other investments or anything else that this person might do. That's just that one fund. Boom, done. And so that's why I love it. And that's the power of that compound interest. So like we'll go back, and I just want to show that one more time, that graph. Like that blue line, that's the contributions. That they only put in 200 and not even just shy of $217,000. It grew sixfold thanks to compound interest over that time. So that is the power of compound interest. So that said, best time to start was 10 years ago. Second best time to start is today. That's a good old-fashioned Warren Buffett quote right there. So even if it's only $20, don't click away from the video, because keep watching, but open another tab in your browser and start an account, put $20 in it, S&P 500 fund, just start the account. That's it. Don't ever think about it again. Then when you can, set something up to automate deposit in there and have it, automatically make a purchase. Just keep buying it. Like another Warren Buffett another little Warren Buffett quote was, time in the market beats timing the market every time. So, because over a long enough timeline, it does not matter about the ups and downs of the market. It really does not. So, yeah. So then, basically, between traditional Roth IRAs, 401ks, the big question, what should you choose? Basically, it comes down to what I told you. Why I like both and why I have both is to offset each other effectively with the tax situation in the future. So having a tax deferred account anticipates having a lower income when I'm older, a lower need to be pulling money out when I'm older, so that I stay in that lower tax bracket. But having the tax-free retirement account means that if I do want to make a big purchase and I do want to take out a big lump sum, I have that account available to be able to do that with, that I can draw big amounts out of. And there are things that, happen when I hit a certain age later in life of minimum distributions, where you're required to take certain amounts of money out when you hit a certain age. But those are details we got to talk about when I have a lot more gray hair and we've got to worry about that. But point is that basically they kind of meant to hedge each other. And so that's my personal reasoning behind having both. But the thought process is tax deferred is, I think I'm going to have less income, and so I think I'm going to be in a lower tax bracket than I am now. And a tax-free or a Roth is, I don't want to pay taxes later. I would rather pay them now. So that's really the big difference between the two. So that's really what those two come down to. Health savings accounts. That's our next big one. And now this is our first tax advantage account that is technically a triple tax advantage account, or a triple advantage account. Contributions are pre-taxed. The investments grow tax-free, and any withdrawals for qualified medical expenses are tax-free as well. So, triple tax advantage. So it's extremely beneficial. If you have if you have a high deductible healthcare plan, you're usually qualified for a health savings account. So yeah, if you have access, use it. And a couple of pro tips with it. If you've got access, consider putting as much in there as you can afford, because like even if you don't use them, even if you don't use all of the funds, like they don't go away. They'll just keep growing. As long as you don't just let them sit there as cash, put them into some sort of an investment. You know, it's kind of a wasted endeavor almost if it's like, oh, I'm going to put it in this tax advantaged account, but let it sit there as cash. You know, put it in an HSA, put it into, you know, some sort of an index fund, and let it grow. And then, you know, it doesn't vanish. You know, so you can let it sit there and use it down the road years from now for healthcare expenses in retirement. Which, I mean, unless you're some sort of superhero, most of us are going to have more healthcare expenses later in life than we do now. That's typically how it goes. So definitely a good idea to have an HSA if you have access to one. And if you've got one earlier in life, the better. Again, all of the investments grow tax free, and qualified medical expenses tax free as well down the road. So get an HSA as early as possible and let that grow into retirement as well. So a couple of really huge advantages for retirement for folks. So yeah, couple of big advantages, big tax advantaged accounts there. And you know, I think that sets the stage to dig a little bit more into the nuts and bolts of investing. So, you know, like we talked about with compounding, and our friend Warren Buffett, you know, compound interest. He called it the eighth wonder of the world. The earlier you start investing, the more time it's got to grow. That's the basic principle of compound interest. You know, you just let it sit there, let it do its thing, and you know, the longer it has, the more it'll grow. So I teased the idea of being able to check investments before ever buying stocks. Here's a little tool that I haven't shown you in any of the previous lessons and episodes yet. It's called a portfolio backtester. One of the ones that I really like is called Portfolio Visualizer. So here is what it looks like. It's just portfoliovisualizer.com. And then I went in just to the portfolio configuration tool here. Under settings, you can set you know, a time period. You know, I went year to year. You can go all the way back, depending on what you put in, back to, you know, 85. You know, so if I go back to 1985, go up to 2024. Let's say I start with $1,000. Okay, back in 1985, and let's say I'm gonna contribute a fixed amount. Let's say that they haven't changed the contribution of a Roth IRA. Okay, let's just say it's always been $7,000. Okay, just for kicks. Let's just pretend. And we started off with $1,000, and we're gonna say every year for 40 years. Okay, right? That's 40 years. 85 to 2024. Yeah, that's 40 years. So let's say 40 years of contributing to our Roth IRA. And we put in $7,000 every year without missing a year. We didn't rebalance anything. That just means, like, did we reconfigure our portfolio? And you can get, the reinvesting dividends. So this means there's if stocks or index funds pay you dividends, does it rebuy that same stock or dividend and reinvest it back into it, or does it just pay you the cash back out? And then what I did was I had one portfolio just be the Fidelity S&P 500 index fund. I had one be a 50-50 mix of the S&P 500 and the US bond index fund. And then I had one be a 75-25 mix. So 75%, 25%. I didn't overcomplicate this at all, because I don't think you need anything more than these two. And that's the honest truth. I will, and you can ask other folks that I've talked to and personally helped set up their investments. This is the exact advice that I have given them, and I'll tell them, depending on how much risk you're comfortable with, you can either go 100% in the S&P 500, you can go 50-50 S&P 500 and bonds, or you can go 75-25 S&P 500 and bonds. But the thing about it is, if you are invested in the S&P 500, you're automatically buying part of 500 different companies. You're automatically diversified. You don't need to overcomplicate it. And so when we click analyze, this gets you a whole lot of information. So if you're a data nerd like me, you can go in here and see all sorts of data on how all three of these would have done in the past. But guess what? They're very, 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 very close. All three of them. And that makes sense, because the benchmark is the S&P 500 itself. But all three of them are very close to each other. But here's the thing. The annualized return, the amount of money that was made, 64.75%, 64.74%, 60.45%, 62.82%. That's annualized return. For the portfolio. So that's pretty darn good. like overall. But like this looks backwards in time. Obviously it can't look forward, but I mean it tells you all sorts of information. So like if you ever want to think about, well, what about this strategy or that strategy, or how would this have done over time, or how would that have done over time? If you really want to start getting into thinking about different stocks or strategies or playing around with ideas, if you are interested in this kind of stuff, and want to start playing around with more complex or detailed strategies, rather than just going out and buying a stock and seeing how it does and potentially losing a bunch of money, you can go in here and see how your strategy would have done over whatever time period. And it costs you nothing. You can plug in whatever strategy, whatever portfolio you want to try over whatever amount of time. So if it was, let's say, for the last 5 years, how would these stocks have done? You can try your different strategies, and it's a good way to kind of get your feet wet without potentially losing a lot of money. And you can experiment and test your theories without having to have a huge bankroll and potentially lose a lot of money. And it's a good way to kind of see how those things would have played out. And my suggestion, if you do that, always use the S&P 500 as your benchmark, because what you'll see is that there's a reason that that's your benchmark, and there's a reason that almost nobody in the history of the entire stock market has ever been able to beat it consistently. Every once in a while, I mean, for short bursts and short periods of time, people will, but over a long timeline, no one does. No one. It just doesn't happen. That's the reason it's the benchmark. That's the reason that's the gold standard. Is those that they keep that top 500 best performing set. And if you buy that index fund, you get a little piece of all 500 of them, and you're just diversified across the best. So, that's typically unless you really are just into it and that's what you want to do as like the thing that you spend all your time on, that's why that's the thing I recommend for a passive strategy for a portfolio, is just S&P 500 and bonds and whatever kind of balance that you want in your portfolio, and that's usually good enough. And that's, if you go out and look up any Warren Buffett quotes on his suggestions, that's what he says too. So it's not like that's an original idea of just mine. So he'll tell you the same thing. And like we said with Rule of 72, compound interest, the longer it sits in there, the better it's going to do. Biggest thing you can do is get started now. Get it set up to automate, and just, let it do its thing. Let it keep doing its thing, and the small good decisions over time. That graph, it'll start really looking good after a while. So I hope this has helped. start lay a foundation for investing. I hope we've given you some good information about some retirement accounts, some tax deferred and pre-tax or tax deferred accounts and tax free retirement accounts, HSAs, the triple tax advantaged, why they're the best starting point, why it's the ideal first accounts to use for building out an investment portfolio, and just getting started here. And we're going to tackle this same way we tackle everything in recovery, one step at a time here, one day at a time. And if I can recommend one thing, me, go just get started, get this thing out of theory into practice. We'll get it automated. I believe in you. If I can do it, anybody can. So, things to do before next week. Take a few minutes, just check and see if you currently are contributing to a 401k or IRA. If your work offers one. If you're not, make a plan to open one. Go out to Fidelity or Schwab or Vanguard or E-Trade or wherever you do your accounts, and just open up a Roth or a traditional IRA. It's a lot easier than you think. You can open one up in no time. If you have it available, open an HSA. If you're eligible, get one of those open as well, and make a plan to start investing in that. And don't talk yourself out of it just because it's not a huge amount of money. If you're only able to do $10-$20, start small. Small is better than zero. Just start. That's the important part. Start small. That's everything starts somewhere, so check that off the list that you started. Feel good about it. That's an accomplishment. So next time we're going to get into other options in the investing world. We're going to talk about other more information about index funds, mutual funds, the difference between those, ETFs, stocks, bonds, and we'll talk about putting together like the right mix, risk tolerance, as well as other more speculative asset classes and things. But yeah, other than that, remember, recovery is about progress, not perfection. We're doing this together. So reach out. Let me know in the comments what you found helpful, if you've got questions. And yeah, if you liked this, reach out. Let me know. If you think somebody else would find it helpful, share it. Support the channel. Subscribe. Let us know how you feel. Say hi on Facebook. Hop over to the Discord. Other than that, tune in tomorrow. We've got our normal podcast, me and Mitchell. And other than that, have a great day. Enjoy the holidays as well. I'm glad to be back doing this live. I should be back next week live as well. And then I've got another I'll be back doing this live. I don't have any more Fridays that I've got to do the contract gig. So yeah, I should be back live full time doing this. So yeah, appreciate it, and stay safe, everybody. Appreciate you.